$3 trillion. That's the size of China's war chest, a reserve pool so vast it can quietly shift the balance of global power. Today, Beijing isn't just holding cash, it is redeploying this capital to challenge the dollar's supremacy through shadowy institutions and calculated strategy. But how exactly does nearly invisible money rewrite the rules of the world economy? The real story starts with who controls this fortune and what they intend to do with it. China's foreign reserves stand at an extraordinary scale. The official tally, managed by the State Administration of Foreign Exchange, better known as SAFE, hovers between $3.2 trillion and $3.3 trillion in recent years. This is the largest reserve pool held by any country, far surpassing Japan, Switzerland, and Saudi Arabia. At their height in 2014, China's reserves nearly touched $4 trillion, a level that captured the world's attention and drew scrutiny from global markets. Today, even after years of capital outflows and deliberate diversification, the war chest remains immense. SAFE acts as the principal gatekeeper, operating under the supervision of the People's Bank of China. Together, they decide how this capital is allocated, monitored, and, when necessary, redeployed. The precise breakdown of these reserves is a closely held secret, but analysts agree that U.S. dollar assets have historically made up the bulk. Over time, however, holdings have shifted. Chinese positions in U.S. Treasuries, for example, have dropped from about $1.27 trillion in 2013 to roughly $800 billion by 2023, even as the total reserve level stayed high. This pattern signals a move toward other assets, including gold and non-dollar securities. The size of this reserve base is not just a statistic, it is a source of strategic possibility. With more than $3 trillion at its command, SAFE and the central bank can influence global markets, support the Renminbi, and provide Beijing with the means to fund new institutions and payment systems. The sheer scale of these reserves underpins every tool China can deploy in its campaign to reshape the world's financial order. The machinery behind China's global financial reach is not limited to the central bank or its foreign exchange authority. At the heart of Beijing's deployment strategy stands the China Investment Corporation, CIC. With assets under management close to $1.35 trillion, CIC ranks among the world's largest sovereign wealth funds. Its portfolio stretches across global equities, bonds, real estate, and alternative assets, giving Chinese policymakers the ability to shift capital away from dollar assets and toward investments that fit their long-term strategic interests. Alongside CIC, China's policy banks wield enormous balance sheets and a direct line to state priorities. The China Development Bank and the Export-Import Bank of China are the main engines powering Beijing's overseas ambitions. The China Development Bank alone controls assets exceeding 16 trillion yuan, over $2 trillion, making it the largest development lender on earth. These banks have channeled hundreds of billions of dollars into infrastructure, energy, and industrial projects across Asia, Africa, and Latin America. Many of these loans are now structured to include Renminbi components, especially for projects tied to the Belt and Road Initiative. Policy banks have received capital injections from China's foreign reserves and benefit from special central bank funding lines, such as pledged supplementary lending. This state backing gives them firepower, rivaling or surpassing the World Bank, all while aligning their lending with China's geopolitical interests. As Chinese holdings of U.S. Treasuries have dropped to around $780 billion, capital is increasingly routed through these sovereign vehicles, allowing Beijing to deploy its reserve strength where it can shape global finance and trade on its own terms. A network of financial pipes now runs beneath China's global ambitions. At the center is the cross-border interbank payment system, called CIPS, launched in 2015. Designed under the supervision of the People's Bank of China, CIPS clears and settles renminbi payments across borders, providing an alternative to the dollar-dominated SWIFT system. By 2023, nearly 1,400 financial institutions in almost 100 countries had joined CIPS, handling trillions of yuan in annual transactions. This network allows Chinese banks and their international partners to move money in renminbi directly, bypassing the old reliance on New York or London for settlement. But payment rails alone do not create a currency's global reach. In March 2018, the Shanghai International Energy Exchange launched yuan-denominated crude oil futures, called the e-CNY contract. For the first time, oil exporters and traders could price and hedge shipments to China in renminbi, not just dollars. The contract quickly drew interest from foreign trading houses and major oil firms. By 2021, Shanghai's crude futures ranked among the world's most active oil contracts, with volumes rising as Russian and Middle Eastern suppliers explored settlement in renminbi. These two innovations, CIPS for payments and e-CNY for commodity pricing, form the backbone of China's push to embed its currency in global trade, especially for energy and raw materials. Foreign investors now have a direct route into China's vast bond market. The Bond Connect program, launched in 2017, serves as a bridge, allowing global reserve managers and institutional investors to buy and sell Chinese government and policy bank bonds from abroad, using Hong Kong as a trading hub. This access is not theoretical. By late 2025, foreign holdings of onshore Chinese bonds had surpassed 3.7 trillion yuan, over $500 billion US, spread across hundreds of global institutions. Trading activity is robust, with average daily turnover on Bond Connect reaching more than 40 billion yuan, and cumulative volumes in the trillions. The scale of China's bond market is difficult to overstate. Outstanding bonds onshore now total more than 20 trillion US dollars, making it the second largest in the world after the United States. Yet foreign ownership remains modest, at just over 2% of the total market. This low share leaves enormous headroom for reserve managers and sovereign funds to increase their positions without crowding. For central banks seeking alternatives to U.S. Treasuries, Chinese government and policy bank bonds are now a viable, liquid option, deep enough to absorb major reallocations and supported by a growing infrastructure of custody, settlement, and collateral services. The market's openness is no longer an experiment. It is a functioning pathway for the renminbi to take on a larger role in global portfolios. China's monetary toolkit now extends beyond traditional reserves and lending. The People's Bank of China has spent years developing the digital yuan, known as e-CNY. Since 2020, large-scale pilot programs have rolled out in cities like Shenzhen, Suzhou, and Beijing. Millions of Chinese consumers have used e-CNY for daily purchases. But the ambition stretches far beyond domestic retail. In partnership with the Bank for International Settlements, Hong Kong, Thailand, and the United Arab Emirates, China has tested cross-border digital currency platforms, settling transactions in seconds. The mBridge project, for example, allows banks in multiple countries to transfer value using central bank digital currencies, sidestepping legacy correspondent banking and dollar-based rails. These experiments are not theoretical. They have processed real cross-border trades, lowering costs and cutting settlement times. At the same time, the People's Bank of China has quietly built a gold buffer unmatched in the modern era. Since 2015, official gold holdings have more than doubled, rising from about 1,600 tons to over 2,000 tons by 2024. For more than a year, the central bank has reported steady monthly gold purchases, signaling a deliberate move to diversify away from dollar assets. Gold now accounts for a growing share of China's reserves, serving as a hard asset backstop for the renminbi. In official statements, People's Bank of China leaders describe gold as a neutral reserve, a global insurance policy that can support confidence in the renminbi during periods of market stress or geopolitical risk. With digital currency pilots and a vault full of bullion, Beijing is building credibility for the renminbi on both technological and hard asset fronts. 1 million barrels of crude oil change hands between China National Petroleum Corporation and a foreign seller. The payment, settled in digital Yuan, bypasses dollar wiring entirely, an official milestone and a quiet signal to commodity traders worldwide. In Karachi, a government official reviews loan documents from China Development Bank. The terms specify repayment in renminbi, not dollars, tying future power plant revenues directly to China's currency. Local contractors now manage renminbi-denominated accounts for project expenses, weaving the renminbi into daily business. In Buenos Aires, Argentina's central bank faces a shortage of dollars. Officials tap their swap line with the People's Bank of China, drawing billions of yuan to pay for imports and shore up reserves. For the first time, Chinese currency fills the gap left by a dollar drought, providing liquidity when global markets turn tight. Each episode, Oil, Lending, Crisis Liquidity, shows China's toolkit in action, embedding the renminbi deeper into global finance. The dollar's grip on global finance remains formidable. Nearly 59% of all official foreign exchange reserves are still held in US dollars, according to the International Monetary Fund. The Treasury market, with more than $25 trillion outstanding, offers unmatched liquidity and depth that no other sovereign bond market can rival. For reserve managers, the rule of law, contract enforcement, and investor protections in U.S. markets add layers of confidence that the renminbi cannot yet match. China's capital controls and limited renminbi convertibility continue to deter many global investors, while concerns linger over state intervention and regulatory opacity. Economists like Eswar Prasad and Barry Eichengreen point out that for all of China's progress, the dollar's incumbency is reinforced by decades of network effects and institutional trust. Looking ahead, two scenarios stand out. One, a gradual rise of the renminbi as a secondary reserve currency. Two, a sudden acceleration if a geopolitical shock erodes confidence in the U.S. dollar. The spectrum of outcomes hinges on policy choices in Beijing and Washington, and on the willingness of global investors to embrace new risks and new rewards. Global finance pivots on trust, and today, $3 trillion in reserves gives China more leverage than ever. As the world's economic center shifts, every trade, loan, and alliance is quietly recalculated. The next era of currency power is not decided overnight. It is being decided now.